And by selling the property to your spouse after 10 years, the depreciation resets based on the new purchase price, allowing for higher deductions once again. This then means that the new depreciation basis is then increased to the new building portion of the value, significantly raising tax-deductible depreciation amounts. As we just discussed, one major deduction is mortgage interest. If you finance your property with a bank loan, 100% of the interest paid on that loan can be deducted from your taxable income. Another important tax advantage you have here in Germany is that you can sell your property tax-free after 10 years. Welcome back to the channel, everyone. Today we're diving deep into how real estate investments get taxed over here in Germany, and more importantly, how you can legally minimize your taxable income using various strategies. If you're a property investor or you would like to become one, this video is packed with useful insights that can save you thousands in taxes. We'll go over how rental income is taxed, how deductions work, and discuss advanced strategies such as the so-called Ehegattenschaukel here in Germany, as well as selling your own properties into your own structure, into your own company structure, such as a GmbH. Before we continue, I want to emphasize that I am not a tax advisor and that this video is for informational purposes only. It certainly doesn't constitute professional tax or financial advice. Always consult with a tax advisor or financial expert before making investment decisions. But now let's get started. First, let's talk about the basics. Rental income is considered part of your overall taxable income. That means it is added to your total earnings and taxed at your personal tax income rate, which follows a progressive system here in Germany between 14 and 45%. In addition, there's a solidarity surcharge of 5.5% and in some cases a church tax of 8 to 9%. Now let's make this a little bit more concrete. Let's use an example here. Let's say you purchase a property for 100,000 euros and you rent it out for 450 euros cold rent per month, giving you an annual income of 5,400 euros. Now let's also assume you have a mortgage on that property with an interest rate of 4%, meaning you pay 4,000 euros annually in interest. Now let's also say you have non-allocable costs which you as the owner have to cover, such as property management or repairs, totaling an additional 1,000 euro per year. After subtracting these costs from your rental income, meaning 5,400 euros minus the 4,000 euros minus the 1,000 euros, you are left with 400 euros in taxable income. If your taxable income from other sources, such as your basic salary, is 100,000 euros, then this 400 euros in rental income is added on top, making your new taxable income to accumulate to 100,400 euros. This additional income is then taxed with your marginal tax rate, which in this case would be around 42% here. And this results then in a tax liability of roughly 168 euros on the rental income. Even though the taxable income from your rental property is relatively low, the key advantage here is that the unit basically pays itself off over time. As we just saw, the rental income covers both the interest you have to pay as well as a large portion of the other costs, meaning you are building equity with minimal out-of-pocket expenses. And in this case, the tenant is essentially paying for your mortgage and financing the investment for you, while you benefit from long-term appreciation and tax advantages. And this is why real estate makes an attractive investment compared to other asset classes. Now let's discuss in more detail how you can reduce your taxable income. The good news is that there are multiple ways to reduce your taxable income with real estate. You can deduct a variety of expenses from your rental earnings, significantly lowering the amount that is actually taxed. As we just discussed, one major deduction is mortgage interest. If you finance your property with a bank loan, 100% of the interest paid on that loan can be deducted from your taxable income. Let's assume you can take out a mortgage with a 4% interest rate, meaning you pay 4,000 euros in interest per year on your 100,000 euro loan. That entire 4,000 euros is deductible, bringing your taxable income down to 1,400 euros. Additionally, as we also just discussed, maintenance and renovation costs are also deductible, meaning any expense from repairing or renovating an apartment can reduce your tax liability. Depreciation, also known as Abschreibung here in Germany, also allows you to depreciate the building's value at 2% per year for up to 50 years. And the building's value is usually 70% of the purchase price overall, meaning if you buy an apartment for 100,000 euros, 70,000 euros are attributed to the building's value. And you can depreciate those costs over a span of 50 years, meaning by 2% per year. And then also other deductible expenses may include property management fees, tenant advertising costs, legal fees, and even operating costs, such as utilities, if they are paid by the landlord, also called these non-allocable costs, which you have to cover yourself. And now let's get deeper into advanced tax strategies. Now that we've covered the basics, let's look at some advanced tax strategies that experienced real estate investors used to optimize their tax situation. One of the most effective strategies is the so-called Ehegattenschaukel or spousal property transfer. This involves selling a property after 10 years to your spouse to reset the depreciation value and to optimize tax benefits. When you hold a property personally, you can depreciate the building's value by 2% per year, as we just discussed. However, after a couple of years, this depreciation becomes less valuable. And by selling the property to your spouse after 10 years, the depreciation resets based on the new purchase price, allowing for higher deductions once again. And let's make an example here. If you have purchased this property for 100,000 euros and the building portion was valued at 80,000 euros, your annual depreciation would be 1,600 euros. Then after 10 years, the remaining book value of this property would be 64,000 euros. Now, let's say the market value of the property has risen to 150,000 euros, which means that you can then sell your property to your spouse at this new price. This then means that the new depreciation basis is then increased to the new building portion of the value, significantly raising tax-deductible depreciation amounts. An additional advantage of this strategy is that you can provide your spouse with a private loan to finance the purchase. Let's assume you lend your spouse the full purchase price of 150,000 euro at an interest rate of 10%, and yes, you can actually charge that from your spouse. The Finanzamt would accept this. The interest payment is tax deductible for your spouse because it's the financing cost for the property itself, while at the same time you declare the interest as income, which may be taxed at a lower rate, usually 25% here in Germany, but this depends on your overall income structure. And this effectively allows you to shift income between spouses in a tax-efficient manner. For taxation purposes, the selling spouse does not have to pay capital gains tax if the property was held for more than 10 years. The purchasing spouse now has a new, higher depreciation base, and the interest payments create additional expenses for the buyer while generating income for the seller. And with this, the overall advantages of this structure include optimizing depreciation, reducing taxable income, and effectively distributing tax burdens between spouses to achieve a lower tax liability. Another advanced strategy is selling your properties to your own corporation, or as we say here in Germany, to your own GmbH. Instead of holding the property in your personal name as a private individual, you can create a real estate corporation or real estate GmbH and sell your property into it. The main advantage of this structure is that profits inside the corporation are taxed at only roughly 15.8%, and that includes the corporate tax plus the solidarity surcharge, and is a lot lower compared to the 45% you would have to pay, or 42% as your personal income tax. Additionally, a corporation benefit from tax deferral, meaning that profits can be reinvested before incurring further taxation. For example, if you sell a property into your own corporation or your GmbH for 100,000 euros and this property generates a rental income of 5,400 euros, instead of paying these taxes with a high personal tax rate, the corporation only pays 15.8% on that rental income. Another important tax advantage you have here in Germany is that you can sell your property tax-free after 10 years. And this is basically unique if you compare this to other European countries, let's say Austria or France or whatever. If you sell your property within the first 10 years, any capital gains are subject to tax at your personal income tax rate. However, if you hold the property for more than 10 years, the capital gains tax is completely waived, meaning you can keep 100% of the profits tax-free. For example, if you purchase the property for 100,000 euro and sell it 12 years later for 150,000 euro, the 50,000 euro profit is completely tax-free. However, if you sell the property after, let's say, 8 years, that 50,000 euro gain would be taxed at your marginal tax rate, which is, again, depending on how much you earn with your main job, between, let's say, 35 and 45%. Usually it's around 42% if you're anywhere above that 60,000 euros threshold here in Germany. And this is why many long-term investors hold on to their properties for at least 10 years to maximize their returns and legally avoid capital gains tax. And that's basically it. Now, to wrap things up, let's summarize the key takeaways again. Rental income is taxed at your personal tax rate, but deductions such as mortgage interest, maintenance costs, and depreciation can significantly lower your taxable income. Advanced strategies like the Ehegattenschaukel we've discussed and using a corporate structure such as creating or founding a GmbH can further optimize your tax situation. Lastly, holding a property for longer than 10 years eliminates capital gains tax entirely, making it a powerful long-term wealth building strategy. Now, if you found this video helpful, make sure to like, subscribe, and hit that notification bell so you don't miss any future real estate tax tips. Thanks for watching this time, and I hope to see you guys soon. Take care. Bye.